Is it going to be a soft landing or a hard landing? However, people don't seem to realize what landing means.
Yes.
Huh? You see, is that everybody's like, oh, it's going to be a soft landing. Well, it's landing,
Yeah.
my friend.
Yes, land.
Landing, landing is a recession. Huh? There is the Federal Reserve, although they don't want to acknowledge monetary aggregates, know that the only way in which you can bring down inflation is by having a significant reduction in aggregate demand for money. If you have a significant reduction in aggregate demand for money for the layman, that means much lower availability of credit, much lower access to credit, all of those elements. And obviously, soft landing means a recession in which there is no massive loss of jobs. That is basically what they're talking about.
Welcome to the Rose Show podcast. Thank you so much for joining us. I have the highest honor of being here with one of my favorite economists, Dr. Daniel Lacalle. He is a highly respected PhD in economics, author of amazing books, chief economist at Tressis, and he has an amazing YouTube channel where he educates everyone on economics. How are you doing today, Daniel?
I'm doing very well. Thank you so much, Rosanna, for inviting me to your channel. It's an honor for me. I follow your work, and it's truly inspirational. So thank you very much for having me again.
Thank you so much. It's our third time together meeting and discussing the truth in economics. And I have to say, I respect your work. I love your work. I watch your YouTube channel all the time. And if you could ask my husband, you're the top on our favorites of subscriptions. So I urge everyone to follow you as well. You know, you expose the truth in economics, and that is a rarity these days when we have the headlines telling us one story, but then when we go under the hood, we see something else. So what I'd like to do today is go into the truth of what you see with all the numbers. And so, and both of our joint goals is freedom for all. So let's start with the debt crisis that we have. I believe you referred to it as a debt time bomb. You know, there's massive government spending, debt to GDP over 120%. We're now at about 38 trillion, plus interest expense over 1 trillion, and they're projecting 50 trillion, I think, in 10 years. The deficit this year alone was 1.7 trillion. Tell us, Daniel, is this sustainable? This can't go on. And shouldn't the government be reducing their expenditures, not increasing during inflationary times?
Mhm. You're absolutely right. It is completely unsustainable. However, with debt, what we see from the average citizen's perspective is that most of the people don't understand how it affects them on a daily basis. They do see the effects, but they don't understand that they're a direct consequence of massive debt. They understand that it's more difficult for them than for their fathers or their grandparents to thrive, to climb the social ladder. They see that it's more challenging to get to the end of the month. They understand all those things, yet they don't connect the dots to massive government spending and huge levels of debt. Debt works like a burden, works like literally like a weight on your shoulders that makes it more difficult to walk every day. And it's a burden on every citizen, even those that are not taxpayers, those that are told that they will be receiving benefits from the government. They actually suffer it from inflation, no inflation, which is, as Ronald Reagan used to say, no, he used to say that inflation is the price of the things that you thought were free that the government gave you. And it was an actually very good analogy. But I think that what we have right now in front of us is a huge debt crisis, because the United States government is pushing the limits of solvency and is pushing the limits of confidence. Ultimately, what people have to understand is that when the government issues debt, it is literally issuing units of confidence that are backed by the currency. In reality, the money that we use every day, our US dollars every day, are debt. No? So what we need to understand is that the higher the level of debt is, the more challenging it is to continue to provide confidence in the currency. The world uses the US dollar for most of the international transactions. But when the government reaches a certain limit, that's there certainly it breaks in numerous levels. It's basically like, you open the tap and the bath starts to fill up, and suddenly everybody blames the last drop for the flood. But the reality is that what happens is that, one, you suffer it from higher inflation, which is what we're living today. By the way, what we lived also when they said that there was no inflation. Everybody that is watching us right now knows that when they told us that there was no inflation, tuition costs, healthcare costs, insurance costs, all of those things doubled, tripled in some cases. No? So all of those elements come: inflation, lower growth, negative real wage growth. Everybody that is watching us right now in the United States has an, I would say, inviable employment situation for, if you look at it from the perspective of Europe, no? But if you look at it from the perspective of the United States, you're getting low unemployment, but negative real wage growth, which means that obviously the situation is not as good as some would imagine. So inflation, negative real wage growth, lower availability of credit, weaker ability to climb the social ladder. It's more difficult for young people to start a family, to buy a home, etc. All those are factors that are second derivatives of massive levels of debt. And like with the last drop of water that creates the problem, the problem is that it doesn't seem to be a problem until it happens. There are no warning signs in massive debt accumulation. When the Eurozone had its debt crisis, the year before, the Greek government was actually extremely confident because, the borrowing cost was low and everything was very good, and it didn't seem that there was any problem, and problems suddenly, boom, materialized. And that's what we don't understand. Therefore, if we don't take care of the problem while it's building, when it happens fast, and it happens in a nasty way in which people suffer quite significantly.
Well said. And that's why we are so grateful for you, Daniel, because you expose the reality. It's absolutely a future burden on the people, and it lowers their standard of living, and it affects the people. However, the people in charge say a different story. Just recently, I'd say about a few weeks ago, Janet Yellen said bond yields are surging due to a strong economy. They keep saying strong economy. Then, as you said, they said inflation is transitory. And, everyone looks up to their leaders. And it's a very confusing story that we see when we have leaders saying one thing, the data, the way it's collected, and the headline shows something else. And then we look deeper and we see, like you said, negative wage growth, and the people suffer. And I want to just quote Alan Greenspan said, the United States can pay any debt it has because we can always print money to do that. So there is zero probability of default. Of course, he's referring to our global reserve currency status. However, I guess my question to you is, how much longer do you really believe this can go on? Because many people are saying, it's not really a problem. They just keep kicking the can down the road. And we know it's unsustainable, but do you think we'll see a day when this could actually really come to fruition in the next, let's say, 5-10 years, or maybe sooner?
Well, having the world reserve currency is a privilege. It's not something that you have inherited and that is going to last forever. Therefore, you have to nurture it, and you have to maintain the confidence in the currency in order to continue to have the world reserve currency. We are speaking today. I'm in Spain today. I just came from India. We're speaking to Spain had a world reserve currency many centuries ago. The UK had the world reserve currency. You lose it. And the thing is, what people don't understand in the United States is that when you lose it fast. You don't lose it, oh, we are losing our world reserve currency status and we have 5 years to prepare. No, is that when you lose it, it's gone. And by the way, when you lose it, it doesn't come back. That's the other important element, is that fiat currencies are called fiat currencies because they're faith driven. Faith as in confidence, no? So can the United States right now lose its world reserve currency status? Not now. Not now, for a very simple reason. There is no alternative. Why? Because most of the possible alternatives, the Chinese yuan or the euro, in fact, are not alternatives. The yuan has capital controls. The euro has a number of risks, including redenomination risks. Okay, fair enough. But that doesn't mean that all those things are going to last forever. And it doesn't mean even that the alternative is going to be a fiat currency issued by a government. Furthermore, it doesn't even mean that it will be one fiat currency, no? So the fact that nothing has happened so far, which is what, from Greenspan to Yellen, from Bernanke to any other, to so many other people mention, the fact that nothing has happened so far doesn't mean that it will not happen. No, it's like basically, one goes out for drinks with friends and has a few drinks and then has another and then has another, and there always is somebody. There's always somebody that says, "Oh, I can handle another one." No, and the United States is in borrowed time. Is that I can handle another one situation, which means it has not had an accident yet, but it is certainly there are cracks in the system. We are seeing that many countries are starting to use other currencies for their international transactions. We are seeing that there's losing faith in the ability of the government to repay its debt. All of those things are important. That's why people need to understand that when the government is telling you that deficits don't matter, what it is actually telling you is that it is pushing the limits on the confidence on the currency, because deficit spending and printing money are two sides of the same coin. It's the same. I mean, obviously, the central bank doesn't print money because they're evil or because they want to. The central bank prints money because the deficit spending of the government is way too high, no? So no, bond yields are not coming down because of a strong economy. Bond yields are coming down because of a perception that central banks will continue to destroy the purchasing power of the currency in which we get our wages and in which we treasure our savings. So that is a big problem, because it's literally a slow default. That is basically what inflation is. Inflation is passing on a slow default to all citizens via worsening of their personal financial situation.
Well said again. Thank you for exposing the truth there. I love your real life examples and how you make the debt like drinking. I think everyone can relate to that. And that's how the US is acting, absolutely. And so I want to add to that, the government spending further fuels the inflation. And I know you made a great point in one of your videos about that recently. And inflation is not over. And it's right now hovering in the threes. And it very well can trickle back up quite easily, and it can happen fast. Now, is the US, we look at the GDP, for example, and we see significant government spending. And it almost seems like the GDP, the G in GDP stands for government. And I wonder if that bloat from the government spending is disguising a private sector recession. Would you say it could be?
Well, I've mentioned it a couple of times that what we're living is a private sector recession disguised in a GDP that is allegedly growing strongly. And why is the GDP so disconnected from the gross national income? No, usually gross national income and gross domestic product go hand in hand, almost very small differences. And in the last couple of years, we have seen a massive disconnect between gross domestic product, the one that we see every day in headlines now, and gross national income. And one of the reasons for it is accumulation of debt and massive government spending, because gross national income doesn't reflect the same elements. No, gross domestic product, for the people that are watching and may not be economists, is government spending plus consumer spending plus investment plus exports minus imports. Okay, so bloating GDP is relatively easy. You just basically have to take massive levels of debt in government spending, and you can also pump consumer spending through massive levels of debt, which is another of the big problems of the United States, is that consumption in real terms is not improving significantly, but whatever is being kept of consumption is fundamentally from massive credit card debt, etc., that has reached all-time highs and all those things. So gross domestic product may actually tends to rise surprisingly in periods of excess debt creation. And we saw it in 2005, 2006, 2007. And everybody thinks that is fine. If you look at the Google searches and look at what people were talking about in 2007, most people were talking about, most economists were talking about a strong economy with a very low risk of crisis, very low risk of recession, boom, and it happens. And I come back to the point that I said prior, which is that risk accumulation happens slowly, but bursts very, very quickly. So yes, GDP right now, gross domestic product, is not showing the reality of the economy. There is a sort of glass half full situation that you may say, and you would probably be correct, which is, okay, fair enough, but the United States, regardless of all those negative things that Mr. Lacalle is saying, the United States is doing much better than Japan, the Euro area, etc. Absolutely. And I will never deny that, because it's a much more dynamic, much more entrepreneurial economy and much more private sector driven economy. But that doesn't alter the fact that if we look at gross domestic product adjusted by the accumulation of debt, 2023 is actually the worst year since 1930 in the United States. So debt gives this impression of wealth that doesn't actually exist, no? And people can relate to that precisely by using the example of 2006, 2007. I remember a documentary that I watched after the financial crisis, in which some people were saying, well, I just didn't know that you had to repay your credit cards. I basically maxed out one credit card, went to another, and that's how we lived. Well, we're basically on borrowed time from that perspective. So gross domestic product is not showing you the reality of what the economy is actually doing. It's incredible to see how weak investment is. It's incredible to see, for example, how poor the level of exports are, considering that the United States right now is one of the top exporters of technology, but also of energy. No? So all those things show that there's trouble in paradise. And the reason why many people see it as optimistically as they do is because, unfortunately, there are other developed economies that are doing worse.
Well said. It's always about comparing and contrasting, and you know, it doesn't exist in a vacuum. So the U.S. may be the lesser of the evils, as you refer. So it looks better in contrast. I love that you brought up what GDP actually is. It involves consumption, investment, government, and then the net exports. And I think I recall you once saying how it's easy to make that number look better because you can have increased government spending and then maybe reducing some imports, and that number can right away look even better. So I always urge everyone to look beyond the headlines, and I always look at the tables for GDP. Very interesting stuff there, and you expose that. And that's so important. That's why we love you, Daniel, is that you bring that up and you let everyone know the truth behind that big number, that 5.2 isn't really a 5.2 in real growth. Do you believe they have any intention of paying back this debt? Do you think that eventually we're going to have to go back to some loosened monetary policy or QE?
Well, I think that, well, to start with, debts are always paid. The way in which they are paid is the problem, no? Because you can pay debt, obviously, by being stronger economically, by having fiscal prudence and generating a surplus, which is a rarity these days. And certainly in the history of the United States, very few surplus years. But I think that you can, and also you can pay it via the words of Alan Greenspan are very dangerous, because it says the US can print all the money that it needs and it's never going to default. Well, huge inflation is a form of de facto default, no? Because when you are printing currency that is not supported by the demand of that currency, like a bond that you issue that suddenly goes down 20, 30%, 40% in the market, it's exactly the same. It's basically the risk of default is transmitted to citizens via inflation. So will they implement quantitative easing? I don't think there will be a quantitative easing program soon, because the Federal Reserve is not stupid. No, the Federal Reserve knows all the things that we're saying, may disagree in the severity, but they're not stupid. And they know that all of the things that I said and we have said in this program are completely true. So they know a number of things. First, the Federal Reserve is loss-making. All of the bonds that they purchased in the last part of quantitative easing in 2020, 2021 are generating negative returns. Being loss-making for the average citizen sort of means nothing, but it basically is literally like having a bank with significant financial troubles, no? And they know that the only way in which they're going to recover their balance sheet position is by strengthening the level of confidence in the currency. So implementing a quantitative easing program would severely damage that confidence in the US currency for no reason to start with, because the other element that the Federal Reserve looks at is, okay, we're not purchasing the US bonds, but the government is financing itself. It may be financing itself more expensively, which it is, obviously, but it's financing itself at 4%. 4% with an inflation of 3 and change percent, obviously, is a positive real return for investors. So that is going to generate some confidence in the United States currency. Why? Because it's showing that there's still private sector investor demand for those units of debt that the government issues. So I don't think that the Federal Reserve is going to implement now a quantitative easing program. However, it is very likely that they will do it at some point in the next 5 years again. Why? Because when you have started this process of monetization of debt, it is very difficult to go back to a process of normalization. And we have seen it in 2021 to 2023, is that the Federal Reserve is basically unable to really reduce its balance sheet. No? So to cut a long story short, quantitative easing is supposed to be a tool that gives time to governments to implement structural reforms, get their finances in order, and reduce debt. But it is also, at the same time, a tool that for governments is a tremendous opportunity to do the opposite. Because if somebody out there is purchasing all of the bonds that I issue, why should I care about the deficit? Which is the message that Miss Yellen and by the way, we also heard when Trump was in power, that they're saying is that, well, it's not, don't think about the deficit, look at growth. Well, if it's a deficit driven growth, then there's obviously a big problem happening here, and you're basically kicking the can further to pass the imbalances to citizens in one way or another. So the Federal Reserve is unlikely to implement a quantitative easing while they're loss making. It's very difficult for them to implement a quantitative easing program in an election year, because it would be perceived, and rightly so, as interfering with the electoral process. And it's extremely difficult to implement a quantitative easing program when you are selling to the public the message of a soft landing and a strong economy. Because think about it, if you're saying to the world that there's a strong economy, that things are okay, and that it's a soft landing, and that inflation is coming down quite rapidly, and at the same time you decide to purchase bonds and to lower interest rates, you're basically saying that the previous messages are all untrue. No? So I don't think that I don't think that it will happen next year, for all those reasons, and particularly because it's an election year.
Well said. Thank you so much for that. Because I know there's a lot of talk of people expecting some type of pivot and loosen monetary policy. But then we see the jobs report today, and the headline number looks strong. I think came down to 3.7%. However, when we look under the hood, we see a lot of government jobs were created, and some of the manufacturing jobs were people coming back from the strike. So that number isn't so great as they want it to sound. And at the same time, like you've been saying, inflation is not over, and they have their dual mandate of maximum employment, which they seem to have at this point. And then so now their singular focus is to lower this inflation. So I want to ask you, Daniel, soft landing, hard landing, no landing. It gets confusing for everyone. Every day we get a different landing scenario. What are your thoughts? What are you anticipating for next year? I know we had Dr. Steve Hanke had said a recession is baked in due to the decreasing in the money supply growth, significant reductions, the most since 1939. What are your thoughts on what you anticipate for 2024?
Well, Dr. Hanke mentioned the exceedingly important factor of monetary aggregate coming down so fast, so quickly. And that also comes in with the message that I was showing before of the private sector recession. The impact of monetary aggregates and the declining monetary aggregates is falling entirely over the shoulders of the private sector. So you might not see a headline recession, but a private sector recession. I think that people think too much about the first word. People think about, is it going to be a soft landing or a hard landing? However, people don't seem to realize what landing means.
Yes.
Huh? You see, is that everybody's like, oh, it's going to be a soft landing. Well, it's landing, my friend.
Yes,
Landing is a recession. Huh? There is the Federal Reserve, although they don't want to acknowledge monetary aggregates, know that the only way in which you can bring down inflation is by having a significant reduction in aggregate demand for money. If you have a significant reduction in aggregate demand for money for the layman, that means much lower availability of credit, much lower access to credit, all of those elements. And obviously, soft landing means a recession in which there is no massive loss of jobs. That is basically what they're talking about. But it has to be a recession only because the previous level of growth seen in 2021 and 2022, but particularly in 2022, 2023, has been driven by all of that massive amount of debt and government spending that was generated in that monster experiment of 2020, in which money supply grew by 27, 25% in the developed economies. So soft landing means recession. What it says is, don't worry, it's going to be a mild recession. Okay. But by now, small and medium enterprises, families, businesses in general are seeing that all of those factors that are not in the headline GDP are already baked in their business every day. It is much harder to access credit, and it's much more expensive. It is much more difficult to finance capital expenditure or home projects. It is much more difficult to get loans for tuition, for mortgages, etc. All of those things are already baked in this sort of strong economy that Ms. Yellen was mentioning. What we have to see is what happens next year, because there's a lag effect. No, monetary aggregates come down significantly, and you don't see it in GDP so quickly. But there is a lag effect, and what we don't know is what is the entire lag effect. Okay, is whether it's going to be in 12 months or in 14 months. My opinion is that what the Federal Reserve is trying to engineer is a stagnation driven recession. So not even a contraction in GDP quarter on quarter, but a very slow level of growth way below the potential of the economy. That is basically what I think is the best case scenario. We also have to take into account the element of inflation that you mentioned, is that with the decline in monetary aggregates that we have had, inflation today should not be 3%, should be 1%, or even zero. This is what people don't understand, is that people are cheering a 3%, 3.2% level of inflation, almost forgetting first that inflation is accumulative, so it's added on top of what we suffered in the previous years. But the most important part is that if you look at the monetary aggregate contraction, is that today inflation in the United States should be zero. In Belgium, it is minus 0.6%, I believe, something like that, no? So it should already be significantly lower than it is. And the reason why it is not that low is because monetary and fiscal policy are working in opposite ways. The government is spending a lot more, as you very well said. Deficit spending is massive. The level of indebtedness is huge. Government is spending as if bond yields were not high. They don't care. No, they don't care. So that obviously means that the aggregate demand is not declining as fast as monetary aggregates are showing. What we don't know is when will that catch up to government spending. And obviously we've had the government shutdown crisis, the debt ceiling crisis. There's going to be another debt ceiling crisis next year, because you just mentioned it. I mean, the speed at which public debt is growing is incredible. I mean, it's so incredible that after the debt ceiling agreement, it had already surpassed the full year estimate just a month and a half later, or something like that. It was incredible, no? So all of those things will catch up. I don't care if it's a recession, if it's a technical recession. I don't care if it's a technical recession. 3.7% unemployment when the labor participation ratio is still below 2009 levels, when the employment to population ratio is still below the 2019 levels, and you have negative real wage growth, is not a strong job market, is a normal job market of a US economy that is much more dynamic than the European or the Japanese one, but it's not a phenomenal figure. And you've mentioned the other aspect is that just the end of a strike has a massive impact on the jobs figure, but the point is not even that, is that I accept all of the official data. Is that what really concerns me is that by now the labor participation ratio and the employment to population ratio should have risen dramatically. So there's job creation, but there is no real underlying strong improvement in the labor market. And that's why obviously real wage growth is negative. It's so logical, because if you really had 3.7% unemployment and a massive contraction in the availability of labor force, and businesses were really demanding more labor force, real wages, not nominal, real wages would be rising much faster, and productivity growth would also be rising much faster. So there's a lot of things that are disguising the levels of unemployment. Now, the level of unemployment in the United States, at least, is very well documented. You have U3, U6, all different aspects, so you can actually monitor the level of underemployment, which is actually quite concerning. But in other countries, they're calling it record employment, with the highest level of unemployment in the entire OECD. So think about that.
Wow. Well, Professor Daniel, you truly are a wonderful professor, because you explain everything and you simplify all these complex topics. Thank you so much for bringing up all those amazing points. The data lags are key. And, when you talk about the labor participation rate, people need to know that we're not even pre-pandemic levels. So that's significant in calculating that real wage growth and looking at the foundation, the strength of the overall labor market, which really isn't there. So well said there. Now, I want to talk about the wall of maturities. People need to be aware that the US needs to refinance about $7 trillion in maturities in a declining broad money economy. And that's going to be coming up soon. Could you tell us about what you're seeing with this wall of maturities and how we need to be concerned about that?
The reason why people need to be concerned about the wall of maturities is because right now people understand the impact of rising rates. No, you ask for a loan and it's more expensive, but they give it to you. What the wall of maturities means is that when the United States needs to refinance $7 trillion of debt that maturing in the next 12 to 14 months in a declining money supply growth environment, is that it will probably not even matter what cost is the debt that you see in a bank, is that they will not give you the credit. Is that declining money supply plus a massive increase in maturities from government means that all the liquidity that is out there, a very significant chunk, is going to be absorbed by the United States government. Because let's start from that premise. The United States government will refinance those $7 trillion. The problem is that means $7 trillion less of liquidity in the economy for families and for businesses. That's why what Dr. Hanke, what Dr. Congdon, and so many others are saying all the time is, this is so crazy, is that you don't understand that you're basically choking the real economy. You're choking the productive economy by, at the same time, bloating the unproductive, the government spending side of the economy. No? So right now, when I speak to US friends, to colleagues, etc., they're concerned about the cost of debt, but they're not concerned about the availability of credit. They can ask for a mortgage and they will get it. It will be expensive, but they will get it. The problem is next year is that probably what they will see is that on top of the high cost, there will be a significant decline in availability of credit. That's what declining money supply growth means. Ultimately, for the economy to grow 2%, money supply growth needs to be in the United States around 4%, more or less. Some may say a little bit higher, but I would say 4% money supply growth for a 2% growth economy. So if you're going to have a 1.5, 1.2% growth economy, or a recession, or a stagnation, I don't care, and at the same time a decline in money supply of about 2 to 3%, that is going to set a very, very dangerous situation for availability of credit for families and businesses. That's the challenge that I think we will see in 2024. So the wall of maturities is important because it basically is a way of you understanding that there's all these people that are going to need to refinance their debt, large corporations, the government, etc., that will refinance their debt. Let's start from that premise. So I'm not talking about a financial crisis. They will refinance their debt. Is that what's going to happen to you, your business, and your family in that environment with declining money supply and with persistent inflation, as we mentioned prior?
Well said. It's like a crowding out of the private sector.
Exactly.
Right? Because the government will get their way, they'll have theirs done, but it's us, the people, that suffer once again. So, Daniel, I have to ask you, with the liquidity drains and the monetary aggregate declines into next year, isn't there too much market optimism? I mean, the market is running like it's, I mean, back to 2020. I mean, November had a great month. What is going on with the markets?
Well, what's going on with markets is very typical of a sort of going from a pessimism shock to an over-optimism shock. It's very typical, no? If you look at how markets reacted in August to October, there was widespread pessimism. Inflation is going to be much higher for longer. There will not be any rate cuts. The Chinese economy is slowing down too fast. There's going to be a recession in the euro area, a recession in the United States. Profits from the private sector are declining. Very negative sentiment, no? And suddenly, that goes from a pessimism shock, which was probably excessively pessimistic, to an overly optimistic shock. And literally, what made the difference was 0.2% difference in the inflation figure. Which is so ridiculous, by the way. Yeah? This shows how we have two generations of traders in the market that have only seen expansionary monetary policies and cutting rates. So a slightly better inflation figure drives immediately the opposite view, is that we will see 125 basis points rate cuts in 2024, starting in March. Therefore, you need to take risk as quickly as possible and to recover that position to the more cyclical side of the stock market. Also, there was a big shock in the pessimistic period, which was, oh my God, asset classes are not working very well, but why are technology stocks doing exceedingly well? No? So it's not just that market participants were overall quite pessimistic. It's also that they were quite pessimistic and incorrectly positioned for both the downturn and the recovery. No, so it's playing catch up. Is the so-called fear of losing out. As the previous too pessimistic scenario, this is a too optimistic scenario. It's very likely that next year we will not see 125 basis points rate cuts. By the way, if we get 125 basis points rate cuts, it would be because the Federal Reserve sees a giant decline in the economy. That's obviously why they would do it. The Federal Reserve is not going to cut rates just because the market wants to. The Federal Reserve needs to see aggregate demand coming down. So if they see aggregate demand coming down, and aggregate demand is public plus private, and the public side is not coming down, then it's because the private side of aggregate demand is declining very quickly. So that would be a massive contraction of the economy. So the reason why I don't think that there will be 125 basis points rate cuts next year is because I don't think that there will be a giant contraction in aggregate demand. But I think that sometimes many people are betting on one thing and the opposite. No, they're betting on soft landing, rising corporate profits, declining inflation, relatively strong economy, and at the same time rate cuts. That makes no sense to me. No, those rate cuts would only happen if the economy is not strong, if corporate profits are showing that margins are compressing, and if at the same time the labor market excuse me, the labor market is weakening way faster. No,
well said. They want their cake and they want to eat it too.
Oh, you bet.
You can't, right?
Oh, you bet.
Yeah, and they can't have it both ways. They want the cuts and they want earnings to go up, and they want the market just to keep running up. I call it a recency bias. For the past like 20, since GFC, we've had this, infinite QE. So, I just think that it's a fantasy land at some point. But it's going to have to come back to reality at some point. Daniel, you're based out of Madrid, beautiful country, Spain and Europe, amazing place. Could you just give us, most of the listeners here, actually, I have global listeners, but most of these were US based. Tell us an overview of what's going on in Europe in contrast to United States.
We have just mentioned all of the weakness elements of the United States, which are very clear. And if you look at what is happening in the euro area and in the European Union in particular, it's much worse. It is much worse because on top of persistent inflation, on top of very high level of debt, what we have is no growth, no growth whatsoever. And even in those countries that are proudly presenting themselves, like Spain, as growing countries within the European context, the level of growth comes most fundamentally from what I mentioned before, massive level of increasing debt. So the European Union problem is the following. In 2008, the European Union and the Eurozone saw what the United States was doing with quantitative easing and thought that the solution to all of the euro problems would be to do exactly the same. And it's relying too aggressively on money printing and on government spending. Think about this. The euro area is in recession in the middle of declining commodity prices, which is a positive for the euro area. It's hugely important. In the middle of a massive fiscal stimulus plan called the Next Generation EU Fund, huge, $750 billion euro package of investments financed by printing money. And on an added element, which is that all of the fiscal rules, the deficit limit rules, have been suspended. So governments are spending as much as they want. There's a massive stimulus package. There is an environment of declining commodities, which is positive for the euro area. And with all those things, the euro area is in recession. Germany is in incredibly dire straits, fifth consecutive month of declining industrial production. This is the industrial powerhouse of the world. And the industrial powerhouse of the world is in a severe recession of the manufacturing sector because of a self-inflicted policy. It's the most ridiculous energy policy ever implemented in any part of the world. The Chinese and the United States citizens should be laughing their way out of this environment, looking at what is going on in the euro area, which has completely destroyed all of its options of competitiveness with a very, very misguided energy policy. And it's destroyed. And it's destroyed the world's industrial powerhouse, Germany, which finds itself now in an environment in which they cannot access to competitive and affordable energy, and therefore their competitiveness has been severely damaged. So the euro area is in much worse position than the United States. And you probably might remember that throughout 2020, most of the analysts in Wall Street expected the euro area to recover faster and better from COVID-19 than the United States because of the enormous stimulus packages implemented by governments, huge fiscal policy expansion, and the furlough job schemes that sort of kept unemployment lower through furlough jobs. Okay, all of those things. And what happened was the opposite, no? So the United States, you mentioned before, it's the best of the worst in terms of the developed economies, and the euro area certainly in a very, very challenging situation because it has not solved its energy problem.
Wow. Sorry to hear about that, but yes, we did read a lot of the stories about what's going on over there. So thank you so much for enlightening us on what's going on in Europe. We hope for the best for all in the global countries. I want to take a plane and fly over to South America. And I want to talk about this new president, Milei, in Argentina. Very exciting. You know, they've had massive government spending there and mass hyperinflation. He wants to abolish the central bank, and he's a Bitcoiner himself, a libertarian. What are your thoughts about what's going on down there? Do you think he'll pull it off?
It's very difficult. It's going to be a huge challenge, but there's no other option. Argentina has a failed currency. Sorry. What the Peronist government has done in Argentina is unspeakable. They have massively bloated government spending, as you very well say, but on top of that, printing a currency that has no real demand has destroyed the central bank. So you mentioned prior that Milei has promised to shut down the central bank. And people say, wow, what a crazy idea. But the central bank is bankrupt. The central bank has net negative reserves of $12 billion. It's ridiculous, no? So the central bank is bankrupt. The currency is failed, is a failed currency. They have more than 15 official exchange rates in Argentina. 15, ridiculous, no? All of them false, by the way. And there is a massive problem of disguised inflation all over the place, no? So inflation is already at 140%, but the real inflation is much higher if you look at the real monetary problem of the Argentine economy. And on top of that, they have 40% poverty. So if there's a lesson here, it's to show that when a country implements upside down economics, which is what they did, no? Which is to put government as the pillar of everything, and political spending everywhere, and destroy the productive sector with massive taxes and massive currency controls, etc. All of that has created an economy that, being a very rich country, is completely destroyed. So the solution is very difficult, but it has to be implemented, because I come back to the point, Argentina is a very rich country. It has strong opportunities in energy, in exporting industries, in tourism, in services, in manufacturing, everywhere. Huge opportunities. But it has to implement a system of legal security, of investor security. It has to destroy the massive perverse incentives that the government has to pass to citizens the destruction of its public finances. And so it needs to, I mentioned before, monetary and fiscal policy are two sides of the same coin, no? The Central Bank of Argentina doesn't print pesos like there's no tomorrow because they're stupid, but because there's no other option, because it needs to finance the monster deficit spending of the government. So they need to curb the deficit. They need to bring Argentina back to a trade surplus by allowing exporters to breathe, and they need to implement a system of dollarization that eliminates the absolutely horrific situation for citizens that is the current failed currency.
Thank you so much for that. I know we read a lot about the dollarization, and I also read that most of the citizens there have saved dollars. They've been saving in dollars already. So dollarization isn't such a radical thought down there in Argentina.
Absolutely. It doesn't make any sense to say that dollarization is not a possibility in Argentina, because it's already mostly dollarized.
Exactly.
There's not even, and I don't know them all, but there is not a single Argentine citizen that saves in pesos.
No, exactly. And they're a clear example of how modern monetary theory is just pure science fiction. I think you've spoken about that as well.
Complete science fiction. The problem with the proponents of modern monetary theory is that they will always say, oh, but Argentina is not a good example because it's not monetary sovereign. Fair enough. Venezuela. Oh, but Venezuela is not a good example because it's not monetary sovereign. Okay, fair enough. Iran. Oh, but it's not monetary. The problem with MMT defenders is that they always say, come on, Mr. Lacalle, you don't know anything about money. Rosanna, you don't know anything about money. Now, we know, we know. However, there is no single place in the world where what they propose has been implemented and has not resulted in the massive destruction of the purchasing power of a currency. Even the United States, the inflationary burst that we are suffering right now, and I come back to the point, inflation may be coming down, but inflation is accumulative.
Well said. Thank you so much for that. Money. I think it's a great topic to end our lovely discussion on. And we've said this whole time about the reduction in our purchasing power, which has been on a steady decline since the 1950s. When you look at the chart from Fred, we've been decreasing, and it actually grew very fast since 2008, and then COVID was just the cherry on top with massive, we doubled. I think it was 4 trillion and plus increasing in the money supply. So with that in mind, what are your thoughts on inflation hedges for the future? I know last time we spoke about gold, and you actually mentioned how Bitcoin has broken away from other crypto, and it's not crypto, it's Bitcoin, its own asset class. What are your thoughts on all of those real assets for inflation hedging?
Gold and silver to a certain extent, not entirely the same. Gold is the best way to hedge yourself against those assets that are hugely correlated, like bonds and equities right now are hugely correlated. When everything goes up, they go down at the they go up and they go down at the same time. So the famous 60-40 portfolio doesn't work anymore, no? So you need to have gold. You have to look at precious metals from the perspective of a much more prudent environment because they're not as good a hedge. And the case in point is silver, no? And the case of Bitcoin is very interesting for what you just said. It's very true. Which is that Bitcoin has separated itself from other cryptocurrencies and has started to create its own liquidity. No? And there's going to be a process of generating further liquidity with some, let's say, division of the units of Bitcoins that exist currently. All of that is positive. But I think that Bitcoin so far continues to be in the process of becoming real alternative. And so I think that it's positive that it's less what it used to be, what was a startup currency, but it's far from being a full-fledged currency. So I would say that you would have to look at Bitcoin more as a good trading opportunity. And gold more as a hedge. And because the process of purchasing power reduction of the currency is going to continue regardless, and probably accelerated with central bank digital currencies. Because of that, you have to be invested, and you have to be invested in equities, and you have to be invested less in fixed income, because fixed income is not fixed and it's not income. The years in which governments created a unit of savings that generated a real return in the long term for families, sort of like treasuries, etc., that has gone. Now it's purely an instrument of money creation.
Thank you so much for that. I know monetary debasement is real. And as you said, it accelerated significantly through COVID, and it may continue so as well. Now, equities. You mentioned equities. Any particular equities that you prefer? You know, the Mag 7, highly liquid. They're the cash generators. And there's no surprise that they remain stronger than the others. I think we said the S&P 500, you got 7, and then the other 493 aren't doing as well. So what are your thoughts in equities?
Well, I think that you have to be invested in US equities, no? And the reason why you have to be invested in US equities is because US equities is where you have the closest level of connection between the interests of the small shareholder and management, no? So you have buybacks, you have different elements of, let's say, management incentives to keep attention, to pay attention to the share price. No, so I think that that is very important. I think that there are very good opportunities still in the United States, precisely because of what you just said, precisely because most of the returns of the S&P 500 have been created by 7 large multi-mega caps. I think that those are likely to continue to be, let's say, strong in an environment of monetary debasement, because ultimately they are the reflection of that monetary debasement. Those technology giants are showing us what the future of everything that we're doing, including this conversation here, is going to continue to be. So I think that there is still a likelihood in which we see technology giants leading the bull recoveries of markets. But I think that 2024 is going to be a choppy year of returns for equity investors. You're going to have to be very prudent and very much about stock picking. And stock picking where? I would say pick companies that have buybacks and that pay those buybacks with free cash flow, not with debt. Look at companies that have strong margins, that have had strong margins in the last 3 years and are able to keep them for the in the following 3 to 4 years. Look at companies that have given positive feedback to investors in terms of their earnings, i.e., that they have surprised positively the market. Don't try to find value in companies that have missed the consensus estimates, because those will likely continue to miss consensus estimates in 2024. No? So 2024 is basically, don't try to outsmart the market and try to pick winners among the losers. Try to pick winners among the winners.
Very prudent advice. Thank you so much for those wise words there. I always like to say cash. We want cash. Free cash flow yields and free cash flow, high free cash flow per share. We want the cash generators. So well said. Last question I have for you. You are a freedom maximalist. You enlighten everyone, so many, on economics. I'm curious, what school of economics resonates most with you, if any? You are on the Mises Institute. You have amazing articles on there. I think everyone needs to read all your articles and come to your website, danielacalle.com. But Austrian economics, supply side, you certainly don't seem like a Keynesian to me. You don't ignore monetary aggregates like they do. Tell us, what resonates with you?
I would say that the Austrian School of Economics is something that I'm very close to, because it's what's closest to reality. No, it's about human action, and it's about understanding the importance of the private sector and the importance of the private sector progress as the driver of growth, wealth, and improvement in conditions for the population. I think it's very important to understand the monetarist side of the of analysis of economics. I think that ignoring monetary aggregates is very unwise, and I think that the Chicago School and Friedman, etc., showed very clearly the importance of monetary aggregates in order to understand what is going on in the economy in the broad picture. But all those are, I think, let's say, parallel and compatible, in my opinion. No, I think that it's not that I don't find interesting Lord Maynard Keynes' thoughts. I think that the problem is that the people that call themselves Keynesian are everything but Keynesian. They don't seem to have read properly what Lord Maynard Keynes wrote about the government saving in growth times, cutting taxes in periods of prosperity, and utilizing those savings in periods of recession or crisis in order to invest in a real economic return projects. No, they have completely forgotten that, and they have decided that every government spending is an investment, and obviously that has led to where we are today. But I think that basically the only thing that I would say is that it's important to not say this school or this other school, but to understand that the Austrian School of Economics, monetarism, and supply side economics all understand that wealth and prosperity come from the private sector, and that the role of government has to be limited to facilitate and provide as a lender or provider of last resort, not of first resort.
I love that. Wise words. Thank you so much for that. Inflation is always and everywhere a monetary phenomenon. To quote the great Milton Friedman, I also love monetarism. And I've actually been recently watching Free to Choose. He had a great series from 1980. I'm watching it as a family show with my kids as well, turning them all into little economists. Austria, I love all of it. And you said it so well. Thank you so much, Daniel. This has always been the highest pleasure to be speaking economics with you.
The pleasure is all mine. I thoroughly enjoyed it as always. I continue to follow you and your work. Continue with that phenomenal work, and thank you so much for inviting me.
Thank you so much. Likewise, I urge everyone to check out your YouTube channel and follow you, Daniel Lacalle. Thank you. Have a great day.
Have a great day. Thank you so much.